First rates, the Nifty and the Sensex will come up. 23,300 is where we are at, 73,615. These are first rates which are coming through for both those indices. The Bank Nifty is down 1/3%. Large part, I'm assuming the substantial portion of the cut that we're seeing on the Nifty Bank is, of course, all Kotak Mahindra Bank. Axis should be pulling in the other direction. The new shares of in Vodafone Idea being listed today. And, the first trades on that also we'll have up on the screen. Mid and small caps, as indices have been pretty strong over the last couple of days, and we'll see where they go as well. Vodafone is starting under 13 rupees, 12.6 or so is where we're at. Mid caps are flat, and I think the small cap index is also starting out absolutely flat. But Sonia is here with more rates. Sonia.
Well, thanks a lot for that. I want to start off with Axis Bank, right? Because over there, I think there's some amount of support that we're getting from Axis Bank this morning. Look at that, 3% higher now. The core revenue, the asset quality has definitely surprised. The loan growth is very healthy at 14%. So that's something the street has liked. Kotak Mahindra Bank is the one that sort of, it's really under a lot of pressure right now. So 9% knockdown on Kotak Mahindra Bank this morning, down almost 170 odd points. If you've joined in late, the RBI has asked Kotak Mahindra Bank to stop issuing new credit cards and onboarding new customers through its online and mobile banking channels. Another stock that perhaps could be under pressure and has been for a while is HUL. So that one is down almost 1.5% right now. And that, I think, is also, some of these stocks are also dragging the advanced decline ratio because of the performance that we've seen. Well, LTI Mindtree has been a disappointing set of numbers as well. Look at that, 2% lower. So we have lots of numbers that have disappointed the street today. Indian Hotels, on the flip side, though, has been a very strong set of numbers. Best quarter four ever. Revenues are up 17%. Margins are up nearly 200 basis points. But this is a stock that has rallied substantially in the last 6 to 8 months. So that's something to keep in mind as well. Apart from that, you have Syngene, which is at a multi-quarter high. The earnings have improved for Syngene. The stock is just a bit lackluster this morning. Macrotech developers, real estate has come back into action in a huge way. So almost 2.5% higher on Macrotech developers, almost inching towards that 1,300 rupee mark now. Strong guidance, they're expecting a 20% growth going forward. Now, today you have a whole host of numbers that will come out. There's ACC, Tech Mahindra, Bajaj Finance, IndusInd Bank, that all will be reporting their earnings. So we're just going to get the stocks one by one to show you what the street is looking at ahead of their numbers. Some acquisitions as well. Happiest Mind will acquire Pure Software Tech, so keep an eye out on that. And our colleague Nimesh just told us about Bharat Forge, so I want to get that stock up on board. Look at it, 4% higher now. There's a double upgrade that has come in from BofA Securities with a target price of 1450, which is a big upside to the current market price. So all in all, you'd have to say the market, the Sensex is now just below that 74,000 mark. The Nifty just hanging at 22,350. Not a bad opening, you'd have to say. Given the kind of run-up that this market has seen, this is just a bit of consolidation. Back to you.
All right, Sonia, thanks a lot for that. We're focusing on a couple of more banking names. MAS Financial, Abhishek told us those numbers were super. The stock is up close to around 5%. So big up move is what we're seeing out there. DCB Bank, we just spoke to the management. They're sounding very, very confident. They're saying they're doubling their asset book in the last few years. And in the next 3.5 years, they're expecting it to double. Margins as well at around 3.65 to around 3.7%. And the return ratio, well, they're expecting to go to around 1% in the next 3 to 4 quarters. So the street likes those numbers. That's building on to the gains. Abhishek sends us another important point in terms of market capitalization. He says that Axis Bank market cap is now higher than Kotak Mahindra Bank because both those two are moving in opposite directions. So just keep an eye out on that stock. Moil, yesterday the stock traded well in the green today as well. It's building on to those gains. So good going out there. Sterlite Technologies, one of those other stocks that are trading with very, very high volumes. So keep an eye out on that one as well, moving higher in the initial few minutes of trade. And some of these sugar stocks as well are coming back in favor. You have Sri Renuka Industries, that's up close to around 3.5%. It's coming up as one of the top volume movers, so that's why highlighting that name. On the flip side, NMDC Steel, well, that stock is under some pressure. It's down close to around 1%. One of the top volume movers in today's trading session as well. CSB Bank as well, building on gains up 2.5%. Indian Hotels, numbers look good, but the stock comes in for profit taking. And as we mentioned earlier, Dalmia Bharat, well, the street was positioned for weak numbers. The stock opened up with a cut of around 4%. Now it's down just around 1.5%. So some bit of short covering is what we're seeing on that name. Prashant.
No, absolutely. Pull up the Nifty, which is down 60 points. So, it's neither here nor there kind of a start. It's lower, but, just 1/3% or so. That's about it. So not really anything very large. Kotak, of course, is the big drag. 10%, 1660 or so is where Kotak Bank is at. Just look at Idea, right? Those shares got listed. The low today on Idea is 11 rupees and 80 paisa, and it's basically moved a full 1 rupee from the lows of the day, and now getting back to almost about 13 rupees. So that initial, I mean, actually, of course, yesterday it was down about 9.5 odd percent. A lot of the ARB guys, etc., would have sold in yesterday and this morning. Mostly, I'm assuming this morning. Volumes are very, very, of course, large with these new shares which are coming through. So that's the picture on Idea. Lots of interest around this one. Look at that on Idea. Big recovery from the lows of the day. It's a very strong, big green candle. Nilesh was telling us about Bharat Forge, right? The double upgrade, 1400 plus kind of price target from Bank of America. It's Bharat Forge is the second biggest volume-led gainer for about 500,000 shares now. So stocks are up 3.6, 3.7%. BSC, day before yesterday, it had a massive 10% move. Yesterday cooled off. It's up another 1.5% right now. Nippon India Mutual Fund is up about 4%. Again, very large volume. Stocks at about 606, 607. Okay, Mr. Birla is speaking. Let's cut across.
So much. Indus Towers stake. Any word on that? Whether
nothing just now. There's no definitive path that we've charted out just now.
All right, Mr. Birla, many congratulations on this big fundraise. Do you think that most of the problems of Vodafone Idea that the group had been struggling with over many years, that is sorted for the next few years with this issuance?
I think so. I mean, without a doubt, right? I mean, we've been in the sector for 2.5 decades now, which shows our commitment to the sector and to digital India.
Yes.
And this is, like I said, a fresh lease of life for the company.
And what about Industar stake sale? Do you have an arrangement with Vodafone PLC that the entire amount of their stake sale proceeds will be infused in this listed company?
Well, not really, but, you know, we're going to see as it comes. So nothing specific at this point.
As per the arrangement, what percentage is there?
I think we are not talking about
Yes.
this.
Yeah.
All right, and the government stake sale, is there any indication on that at any point to monetize?
We're not talking about stake sale at all.
At some point they would like to monetize it. Do we have any understanding?
I think you are jumping many guns. I don't think that's the plan at all as of now. Okay.
All right. Thank you. Thank you.
Short and sweet. Our colleague Nisha Podar taking those questions to putting their questions to Mr. Birla. And of course, what he said at the bottom of the screen, fresh lease of life for the company. That is Vodafone Idea. In terms of what the government may do with their stake later on in terms of monetization, etc. Nothing on the annual, at least right now. And this is looking good. Stocks, of course, also come up quite a bit nicely from the day's lowest point. I was talking about stocks. Moil is up another 2%. Nigel was highlighting this name yesterday. It was up 2.5% yesterday, another 2% this morning. Sterlite Tech is up about 4%. It's got strong volumes as well. And something like a Z has come up, right? Z is up about 2%. Stock's 143, but then it's come to 143, 145 many a times and then sold off. So we'll see if this move is here to stay. What else? I mean, in the broader market, I mean, I think this is about it for now. I think the others we mentioned, Tata Consumer is down another 2% right now, 1,089 right now. Titan is down about 1%. On the downside, AG's Logistics, which has had such a large rally recently, that's starting about 1.25% lower. And there is something like a Phoenix Limited, which is down about 3.5%, 4%. So stocks at about 3072, and it's got volumes to go for it right at the word go. Our market master of the day is with us. Gautam Shah is founder and chief strategist at Goldilocks Premium Research. Gautam, good morning. Good to have you with us here. Thanks very much. We seem to be in a bit of a waiting room, Gautam, waiting for the next move, up or down. And the index over the last couple of days seems to have also quietened down, although from the lows, we got a 1,000-point move up and then a 1,000-point down move, and we've retraced that quite nicely. Where does it leave us? I'm talking about the near term, next 1.5 odd month, because in this time frame, you'll also have the election results. Gautam.
Good morning, Prashant. Well, I think the waiting room is much better off than going downhill. I think that's something which people would not mind. And it's just not been the last few days. It's actually been the last 4 months. Because we've been in this, band of about 1,000 points. We've oscillated between greed and fear. 22,300 has been a sort of a marker number. We go 500 points above that. We go 500 points below that, and there is no follow-up. But I think this is just quality consolidation that has taken place. The market is showing a lot of maturity. And the way we have handled two major geopolitical developments in the last 5 to 6 months, it just tells you that this domestic liquidity angle is really bailing out the market every single time. So I just see this as consolidation. I think the problem is there is no real leadership because banks are not doing well. Reliance is unable to get past 3,000. The IT index hasn't been able to do well. But I think the comeback in the last 1 week tells me that the market breadth is back because in general, themes have done well, stocks have done well, but the indices have not gone anywhere. And I think once we get past 22,500, 22,800, which I think will eventually happen, then possibly you'll see the next 5-6% move. But the trade is still not about the Nifty and the Bank Nifty. Stay with the outperforming sectors, and I think there is still a lot of money to be made.
Oh, yeah, absolutely, no doubt. Pull up UBL. I just want to make a quick mention before I toss it to Sonia. UBL is up another 3%. You know, it was a big mover yesterday. We were discussing this with our technical analyst in the morning and Deepan as well. So another 47.50 rupees coming through there, 20.78 on that, backed by volumes as well. Sonia.
It's hot, right? I mean, this summer, the demand just goes up across the board, right, for stocks like UBL. But Gautam, hi, good morning, and thanks for joining in. You know, this is a out-and-out bull market, right, we're looking at. We haven't got any major dip in the last 1 year. It's climbed every wall of worry, as you just said so yourself. So what do you do now? Do you continue to buy, hoping that as we head into election season, as perhaps, you know, the incumbent government comes back to power for the third time, do you think that will give a fresh lease of life to this market? Or are you starting to get a bit cautious at these levels?
Well, I think it's a bull market where you don't need to overanalyze. I think you just need to stay in the bus and not thinking about getting off on every single correction that happens from time to time. And I think all of us pretty much agree that election is in some sense a non-event. So in that sense, I don't think the market is very excited or worried about it. I think we're just going through the motions over the next 4 to 6 weeks. And whatever the outcome, I mean, we pretty much have some sense. I think the markets should be okay. So that might not be a big trigger. I think the big trigger is really going to be earnings and whether the Indian markets can actually, you know, deliver on the fundamentals, because, you know, we've really run ahead of ourselves in the last couple of months. But I do believe that, you know, if you compare with the last bull market, wherein you routinely saw corrections of 10 to 15%, 5% has become the normal 15%. So in that sense, I think this shakeout, internal rotational shakeout that happens from time to time just makes the market healthy. So stay with the right pockets. I think the index is safe till we are above 22,800. Until that number is safe, I think long-term investors should just, you know, look at this market and stay with this market going forward.
Okay, all right. Hi, Gautam. Just hold on to that thought. You know, I want to focus on Tata Chemicals. China's soda ash prices are up by close to around 5% today. So that could be the stock on the radar for the time being. It's trading with some mild gains, but just keep an eye on that one. Tata Chemicals is the stock that we're talking about. Soda ash prices up 5% today. Sometimes in the near term, it does have some kind of impact as well. Well, Gautam, I wanted your view on a couple of these big movers. You know, particularly in today's trading session, we have fundamental news that's putting pressure on Kotak Mahindra Bank. And the stock is down close to 10%. But otherwise, it's been an underperformer as it is. You know, on the charts, how's it looking? At some point of time, value will emerge. It trades at around 2.5 times price to book. So there could be some derating. But fundamentals aside, technically, how's that one looking?
You know, Nigel, the market knows best. I think whenever I've spoken to a lot of HNIs and corporates, I think the key takeaway is that Kotak as a stock hasn't done anything in the last 2 years. In fact, it's been a bigger underperformer than even HDFC Bank that we talk about. I think in some sense, the market knew that there was a problem somewhere, and probably the news is now out of the way with what has happened in the last couple of days. But, you know, this is a market where you don't touch underperformers because then you don't generate alpha in your portfolio. And as you know, we've been a very big bull on SBI, and we continue to believe that that is the banking stock you need to focus on for the rest of the year. But otherwise, you know, all other banking stocks, I think stay away because the Bank Nifty also seems to be in a range of about 46,000, 48,500. Until we don't get past the range, I don't think you're going to see any fireworks in the banking space. So SBI in the PSU names and ICICI in the private names are the two banks we are betting on. But I do believe that metals is still the trade of the year. I think I spoke about it in the last interaction as well, and it's had a fabulous run. I think this is going to continue.
Gautam, so where is the momentum? Where is money going to be made? Give us ideas.
Yeah, so I think there are three themes that we like. Metals, as I said, I spoke about it last time. I think this is a a structural trend. A lot of people whom I speak to are not unable to join the dots from a technical and fundamental standpoint, but now the fundamental triggers are gradually coming in. And you've had amazing moves in stocks like JSPL, Vedanta that we covered recently, Hindalco, Nalco. SAIL has been a favorite, and I do see that stock doing very special things over the next 6 to 12 months. So I think the metals index is set for another 10 to 15% upside for sure. The other high conviction idea that we have is chemicals. I think that's a space that has come back strongly in the last few days. SRF, Tata Chemical, Deepak Nitrate, Aarti Industries, all very good stories coming out of 2.5 years of consolidation. So metals, chemicals, pharma, and select banks and select PSUs are the spaces that we like.
Chemicals, are they out of the woods, you think? Or this is a turnaround bet? When you look at technicals, I mean, you're supposed to bet on sure things, right? So when you're saying that you like it, I mean, I'm assuming it's turned the corner.
Yes, Prashant, I think the way we do our technical analysis, it's not just views, it's commitment. And I think we are committed into chemicals because we feel that this time is indeed a genuine breakout. So I do see a 10 to 15% move on the entire chemicals index, which is a custom index that we prepare at Goldilocks. And some of the top stocks that I highlighted, I think could do special things. It's just that they were the poster boys in 2020, 2021, lost their way, went through a large correction. Now coming back, there is a lot of tailwind fundamentally as well. And given the China factor, I think there are feelers on the charts that the uptrend, which started in 2020, is now resuming. So all the top quality stocks in chemicals should do well over the next 6 to 12 months.
Got it. You were bullish on the auto sector for the longest time, and that is a space that has done really very well. But I don't see it in your bullish list anymore. You think the run is done there?
Yeah, I think auto and real estate were our favorites, a year back, and they did very well for us. And now I think we've come to a point where a risk reward does not justify taking aggressive bets in the auto space, whether it's an M&M or a Tata Motors where the story is played out. But there are two stocks that we like and we actually recommended recently to our clients, and that is Eicher Motors and Escorts. And I think these two stocks could do special things along with Maruti, which seems to have now got into 5 figures comfortably. It was toying with that 10,000 level for a very long period of time. And now that becomes a base. So these three names in the auto space, I think could generate alpha for your viewers over the next 6 to 12 months.
Gautam, when I asked you about chemicals, the only reason I'm asking is because it's one of the few spaces which is underperformed, right? So when you put out that call on chemicals, it's not just people who are chartically inclined who are going to be listening to you. It's also going to be the value guys, the fundamental guys who are going to try and match their views in terms of what the turn is and what you're seeing on the prices. So good to get that. Thank you very much, Gautam. Good chat as always, and appreciate your time here on CNBC-TV18. The market's down about 60 points. We're at about 22,345. But we're going to talk about real estate, Nigel. Well,
let's get straight to that then. You have macrotech developers that reported a very, very good set of numbers. The stock, in fact, was trading higher. It's come off the high point of the day. But FY24 was an absolute stunner for them. What's the outlook with regard to FY25? We have Mr. Abhishek Lodha, the MD and CEO of Macrotech Developers, who joins us on the show. Hi, Abhishek. Good morning and good to see you in. Well, you're looking at a pre-sales turnover of closer around 17,500 crores for the next fiscal. That's FY25. Break it up for us. What is the launch pipeline looking like? You had price increases in the past year of close to around 5%. So how much of this growth will come in because of price increases? And what should the volume number look like in FY25 in comparison to FY24?
Good morning. Very good to be with you. We closed FY24 in line with our projection for 20% growth and grew a little over 20% to pre-sales of 14,500 crores. And our embedded EBITDA margins were at about 31%. We as a company are striving to ensure that we have predictable growth and we have profitable growth. And both those parameters are very important for us. For fiscal 25, our guidance is for another approximately 20% growth in pre-sales, bringing us to about 17,500 crores of pre-sales and an embedded EBITDA margin of about 31%. In terms of the mix of the pre-sales and pre-sales growth, we're looking at price growth to continue to remain below wage growth because that's consistently being our effort to make sure that affordability keeps getting better and more Indian families can afford to buy a high quality home. So we're looking at about 5 to 6% price growth for the coming fiscal, and the balance 15% coming from volume growth. The volume growth can again be broken down into two parts. Volume growth from existing locations, which will be somewhere around 4 to 5%, and the balance 10% will come from volume growth from new locations.
Okay. I want to understand, since you said new locations, Abhishek, I'm going to take that forward, right? While most of the Bangalore-based players are rushing to come into the Mumbai markets, here you are taking your projects to the Bangalore area. I mean, 2 pilot projects have been kicked off in Bengaluru. So I want to ask you, how has the response been? Primarily because, there is a lot of talk about oversupply in the Bangalore markets and the fact that price hikes have not come along for a while. How are you looking to sort of navigate that space, and what is the kind of launches that you're looking at over the next 1 to 2 years?
Sonia, hi. When we talk about new locations, for us, new locations are not just new cities, but they are new locations within each city that we operate in also. Our broader thought process is that consumers in India typically like moving to a new location which is within 2 to 4 kilometers of their existing home, so that they don't disrupt their existing life, including education for kids, office commute, social network, and so on. So we continue to want to have more presence in the 3 cities that we are operating, which is Mumbai, Pune, and Bangalore. In Bangalore, we started off with 2 launches last year. Both of them were very, very successfully received. We did about 1,200 crores of pre-sales from Bangalore from these 2 launches. Our pricing was much higher than what one would call other competitors in the market, because we also, in our opinion, offer much superior product, are spending more on our construction, and therefore the consumer is getting better value. We like the Bangalore market because jobs are being created, wealth is being created, and there is a desire to have higher quality housing. And that's the same trend we've seen both in Mumbai as well as in Pune. So we do think that the Indian consumer is becoming more aware of the fact that the house plays a very, very important role in the quality of life that one lives, particularly because our urban infrastructure is not the greatest. And therefore, there is a growing desire to buy from the most reputed players and buying in higher quality projects.
Correct. It's interesting you say that apart from new cities, you're also looking at new micro markets within the same city, right? We were having this conversation with Boman Irani of Rustomji a couple of days ago, and he said that there's a lot of interest in some of these newer micro markets, whether it's something like a Versova, Chembur, Bandra East, some markets that you've never really thought of being luxury home markets. You guys are also looking at places like Pallava and Upper Thane. Of course, you've been there. But what are the other new micro markets that you're looking to target within the MMR region? And where do you see potential?
Sonia, like I mentioned, we want to be present like a supermarket is every 2 to 4 kilometers within every city that we operate in. Mumbai, of course, we are closer to that. And then in Pune and Bangalore, it will take us more time to reach that depth of being present every 2 to 4 kilometers, so that any consumer who wants to buy a home has a Lodha option which fits within his geographic preference. We don't think it's driven by having a luxury offering at every location. The offering has to be reasonably fit to the demands of the target audience in that location. Every product has to be high quality, and that's what really Lodha is known for and stands out for. But it can be across different price points.
Yeah, Abhishek, hi, good morning. For Pallava and Upper Thane, I think you've given some big targets, right? Total sales of between big numbers, 175 to 200 billion kind of numbers. But these are very long-term targets, 30 years down the line. Could you kind of tell us why targets with such a long time frame?
Hi, Prashant. Good to speak to you again. Pallava and Upper Thane are 2 large developments in the outskirts of Mumbai, are really a play for anybody who views India's long-term development. The reason we chose to look at the 30-year time frame, because the government has given, the Prime Minister has given a approximately 25-year time frame for India to become a developed nation. And we think that these 2 developments are a true blue-blooded play on India's development. Here we have land of about 600 million square feet of development potential. We have built the infrastructure. We have high quality of social infrastructure. The government's large infrastructure initiatives are all in that region. And we now have a situation where in addition to mid-income and affordable housing, we are going to have premium housing come through in these locations. So while we, of course, have talked about what sales we will on an aggregate basis likely to generate over the next 3 decades, we are, of course, also breaking that down into what we expect to do, over the foreseeable near term and medium term. So that, of course, is all part of the overall thing. But we do need to take a view that, it's rarely in the aspect of development that you can get such long-term outlook and you can get such long-term visibility, which is one of the things which makes us stand apart as a company, is how we can have long-term visibility and long-term cash flows coming from these two very, very strategic locations.
And that is, got that, well put, Abhishek, and that is $1 billion, is it? Just to confirm those numbers?
Yes, that's US dollar billion at current exchange rates of one US dollar being 83 Indian rupees.
Okay, got that. Abhishek, we're people who watch us usually look at whether stock ideas. Let me ask you, since I have you and you're the best mind to ask you the best property idea. Of course, without saying, it's Lodha. I'm assuming that's what you will say. But which are the micro markets in and around Mumbai where you think one can expect? I mean, where there is a structural kind of tailwind. If you can identify one or two, I think it'll be helpful for viewers. Even from an investment point of view, which are the best placed micro markets around Mumbai?
I think, Prashant, that's the beauty of housing, is that housing will give you consistent compounding and, with very high tax efficiency for long durations of time without having the volatility which comes from some other asset classes. Today, even if you take conservative price growth of about 6%, when wage growth for the white-collared worker is more like 9-10%, and you take a rental yield which is about between 3 to 4%, you're getting housing without you needing to do anything special, giving you 10% total returns on an annualized basis, and it can be higher if price growth is higher. So you're talking about 10% returns, which are going to come through from any location that you buy housing. Just take care that it's a good location, good access, and you're buying from a reputed developer.
Which are those? I'm looking for value bets. Not in the stock market parlance, we say what is overpriced and what's the undiscovered gem. So I'm looking for undiscovered gems, not completely undiscovered, but relatively. Give us one or two micro markets.
Prashant, I'm sorry, I won't have that view because, I think that the best value is not created by paying, whatever the lowest entry price is. It's by paying fair value for good product and allowing the compounding to take place over a reasonable period of time.
Okay, all right. We'll press next time, Abhishek. We're out of time. That's the only reason we're stopping. Thank you very much for joining us and running us through what you make of the real estate picture and sounding bullish, and of course a little bit about the F525 guidance as well. But I think from real estate to banking, Sonia.
Yes, real estate to banking. There's a lot, that we're talking about this morning. Equitas Small Finance Bank is the next management on the show. The asset quality continues to deteriorate. Q4 FY24 disbursements were also on the lower side year to year. P.N. Vasudevan, the MD and CEO of Equitas Small Finance Bank, is with us. Mr. Vasudevan, thanks a lot for joining in. Always good speaking with you. This asset quality deterioration is something I want to talk about because gross NPAs are at about 2.6%. What led to that? And if you can just tell us about what the way forward is, what's the target gross NPA by the end of FY25?
Yeah. Hi, good morning. We are, I believe that Equitas, we have come back to the near normal level of the pre-COVID scenario in terms of our portfolio quality. If you look at the gross NPA between the third and the fourth quarter, it's gone up by about 14 basis points. Out of this 14 basis points, there is a one-time effect because, we had sought a clarification and RBI has clarified that in case of co-borrower, any agreement where a co-borrower becomes when an account becomes NPA and there's a co-borrower in that account, and then any other agreement where the co-borrower is a borrower or a co-borrower, those also need to be classified as an NPA. That's something that we had got a clarification from RBI. And that had a one-time effect on the NPA because we did that in the month of March. So that came to about 10-11 basis points of that NPA. So out of a 14 basis points increase, about 10 to 11 has really come from that. So more or less the GNPA otherwise has remained steady. And, pre-COVID also our GNPA used to be around 2.5 to 2.6. And today it currently continues to be at that same level. So I believe that more or less we are back to our normal levels.
Back to your normal levels would be what? What is the gross NPA that you're targeting by the end of FY25? And where do you see incremental stress coming into the book? And if yes, where from?
Yeah, so we expect that our GNPA should be at the same levels, 2.5 to 2.6 is where we should expect for FY25. And none of the portfolio segments where we operate are showing any particular stress level. So I don't think we are really having any concern on any particular segment. And this is a very much kind of a normal scenario for us.
Okay, all right. Hi, Mr. Vasudevan. Good morning and good to see you, Ben. Give us an outlook in terms of growth. What is the growth you are penciling in? Which segments will fire up that growth? And also, what about the NIMs? You know, the NIMs, I think they're holding. There was a bit of a dip on a sequential basis. So where does it move from here on?
Yeah, so on advances growth, I think we have been consistent in our communication that we should be looking at around a 25% growth on a medium-term basis. So that's something that we are geared for, and we should be able to look at that going forward. In terms of NIM, yes, there has been a reduction through the year. We ended last year at 9%. That is 23 FI, we ended at 9%. And 24 FY24, we are ending at about 8.16% for the quarter. And for the full year, it is 8.35%. So there's been a drop. And that drop is largely because we had an increase in interest rate of nearly 90 basis points through the last year. And parallel to that, or simultaneous to that, we also did a lot of work on reducing our CD ratio. You know, we started the last year at about 100%, and we ended the last year at about 87%. So that was a large amount of work we did. That's why you see our deposit grew by about 43% against an advance growth of 23%. So most of the impact of CD ratio and the interest cost repricing has been done in the last year. And so we believe that this year, that exit of 1.6% NIM that we exited at, we should be able to look at a NIM anywhere between 8.1 to 8.15% for this year.
Okay, all right. Okay. Give us some more clarity then. Credit costs going ahead, what should it look like? If you could give us a guidance for this year.
So last year, our credit cost was 1.01% on advances. And historically, our credit cost has been in the range of 1.2 to 1.25% on advances. That's been our normal experience all these years. And I think we are very close to that. So this year also, we should pencil in a credit cost on advances of anywhere between 1.2 to 1.25.
Okay. On the rural side, can you tell us any stress that you're seeing in terms of rural loans right now?
See, for us, microfinance, we have nearly about 40% of our book on the rural. The remaining 60 is largely semi-urban and urban. And outside of that, our commercial vehicles will have some presence in the rural. But otherwise, the remaining is largely on the urban and semi-urban. And in our own portfolio, actually, we don't see any difference in portfolio behavior between rural and semi-urban, urban.
Okay. And you have been shifting your focus away from NBFCs to some of the smaller businesses, right? What is the segment that's looking the best for you right now, and what's the outlook on growth?
So we used to finance NBFCs. We used to give loans to NBFCs earlier, but that's a very tactical stuff. You know, we were sitting on 26% capital adequacy at a point in time, and the rates were also kind of giving us a decent return. But today, our capital adequacy has come down to 21.7%. So we are not really sitting on large surplus of capital to allocate to, all businesses. So we are trying to be prudent in our allocation. So NBFC, since it's not really a part of our strategy, it's just part of our tactical stuff. So we have just kind of slowed down on NBFC lending. And you should see more of that NBFC portfolio actually coming down over the next few quarters. But otherwise, our growth has been strong in all our other segments. Microfinance grew by about 20%, and the rest of the book grew by about 24%, giving us an overall growth of 23%. Our flagship program, of course, is our small business loans, which is almost 38% of our book, and that continues to do extremely well.
Okay, all right. Mr. Vasudevan, final question then before I let you go. You're saying that the cost of funds, that seems to be bottoming out. Your CD ratio is pretty much in check. What should the ROA look like? What is the target out there? That's point number one. And you've repeatedly mentioned, that your focus is on getting yourself tech savvy, and tech ready for the future. That will involve some cost as well. So what will the cost to income ratio look like? ROA and cost to income ratio. Please go ahead.
Yeah, so we expect a further about 8 to 10 basis points increase in our interest cost, by which time most of the old deposits should have got repriced. And so the cost of funds will kind of become a steady state after that. And our CD ratio, as I mentioned, we are at about 87, and we want to bring it down to 85 by March 25, which is a 2% over the rest of the year. So it will not have much of an impact on him this year, unlike last year. Because of this and the fact that our yield on advances, yield on disbursement has actually gone up by 1% over the last 1 year. At 18.75%, it's been going up over the last 1 year. And there'll be a lag effect of that on the advances. It takes about 2 quarters, 3 quarters for the advances to start showing that increase in yield. So a combination of all of this, we believe, should help us maintain our steady state ROA. Last year our ROA was 1.99%. I believe that we should be able to maintain that more or less going forward. And in terms of cost to income and our investment in technology, there are 3 areas we have been investing in technology. One is customer acquisition, second is customer experience, and third is internal controls. We are also spending a lot of money and a lot of technology being deployed to improve our internal controls and making it automatic straight through processing. And all of this we have put out in our presentation also. We are expecting to invest about 520 crores over a 3-year period on all these parameters. So we don't really expect our cost to income to dramatically come down. We will still be doing a lot of investments to build the bank for the future. So our cost to income, which is about 62% in the fourth quarter, should remain steady between 62 to 65% over for the next year also.
Mr. Vasudevan, cost of funds will go up before they flatten out, right? That's essentially what you said, 8 to 10 basis points.
Absolutely.
Okay, all right.
We still have some old deposits still maturing, so that will be a 8 to 10 basis points impact.
Good conversation, sir. Thank you very much for your time here on CNBC-TV18. Appreciate it. So that's Equitas Small Finance Bank with some perspective and lots of numbers for FY25. We'll take a quick commercial break here. We'll have Renu Baid, the Vice President, Research, IIFL Institutional Equities. We discuss trends in the capital goods space. Stay tuned. Welcome back. It's time for our special segment, Quarter Se Quarter Tak. We bring you earnings expectations from various sectors, and Vamakshi today is going to tell us how the setup for the capital goods space really is looking like. Vamakshi, over to you.
Well, absolutely. It has been a dream run for capital good companies so far. In fact, in the quarter ended March, on an average, the industry is expected to witness a nearly 16% growth in the revenues, and this will be supported by strong execution as well as record high order book across most of the companies. Cost saving measures as well as operational efficiencies could lead to a nearly 14% jump in the EBITDA. However, the margin outlook remains mixed. On the profitability front, however, a 17% jump on an average is expected across companies. Now, while the order flow has been robust in the recent quarters, a slight moderation is expected this time around, and that is mainly on account of the elections. Nonetheless, steady order inflows are projected in segments like renewable energy, power, transmission and distribution, as well as defense. Private investment investment has been selective so far, is also seeing some green shoots. So overall, the order momentum is expected to pick up meaningfully only after Q2 of FY25. Export orders, however, are a concern given the sluggishness in most geographies, geopolitical tensions, as well as trade disruption. Now, against this backdrop, all companies are forecasted to achieve double-digit revenue growth across the board, and on an average, this ranges between 13 to 25%. Margin projections vary. GE, T&D, Kirloskar Oil and ABB India are expected to witness expansion anywhere between 1 to 6% in their margins. BHEL, Siemens and to some extent Thermax, however, may see some pressure. With the exception of BHEL and CG Power, net profits are expected to climb for most of the companies. Now, in terms of stock performance, capital good companies have seen a very strong surge with returns exceeding nearly 75% across the board for all companies. In fact, on a year-to-date basis as well, the stocks have gained anywhere between 18% to an impressive 114% for some counters. However, this strong surge has in turn pushed current valuations above the historical averages, and the question still remains, can these premium valuations sustain? Will private capex drive the next leg of growth for these capital good companies? Well, only time will tell.
All right, thanks a lot for that. Renu Baid joins in. She's been tracking this space very closely for a long time. Renu, welcome to the show. In your coverage universe, which are the stocks that you're most bullish on this earnings season?
From an earnings perspective, this season, I think companies like Bharat Electronics, ABB, Cummins, data and small cap space companies like Data Patterns, and even EPC companies like KC Kalpataru from the lower base should bounce back strongly on the earnings side. But names like CG Power, Siemens and Thermax will just see barely single-digit growth in earnings because of a very high base last year. So to that extent, we expect some moderation on the earnings side for some of the diversified industrials.
But for stocks like BHEL, just one follow-up there. I mean, they've rallied substantially, right, in the last 1 year. So do you see valuation headroom as well, or are you cautious because of the kind of rally we've seen?
We don't have a formal coverage on BHEL anymore. But yes, I think the rally primarily has been on the back of very strong reversion in terms of the order inflows for the thermal power. Execution, balance sheet repair is yet to be seen. So I think that is where one sees disconnect between valuations and the on-ground fundamental earnings outlook. So it's primarily linked to the revival of the thermal ordering cycle.
Renu, hi, morning, Prashant here. What is when you speak with investors, what do they want to see? Is it just order books which continue to grow? Is it now execution? Is it improvement in profitability? What is the real, if there is one dominating driver, which will drive share price performance from here for the sector?
The lead indicator for the sector has always been order inflows. And time and again, investors look that as an anchor to peg their earnings outlook, forward earnings outlook. So I think order inflows have been the key. If I have to put one single catalyst, it's that. But it's just not order inflows. Investors also look for execution efficiencies, profitability. So the stock performances eventually are a factor of all of these elements. But yes, if it's one single element deciding factor, then it is order inflows as the headline number, as an indicator for future growth.
Okay, all right. Hi, Renu. Good morning. Nigel on this side. I had a two-part question. Since we're getting to elections, the government's order inflow could slow down a little bit. So are you bracing for a soft first half of the year and then a recovery in the second half of the year? So that's on the government spends, which actually has been very, very good. And on the other part of it, private capex is expected to pick up. Are you seeing green shoots?
So in terms of order flows, it's customary for election-related slowdown in order flows. That is already priced in terms of the assumptions for fourth quarter partially and for the first half of fiscal 25 across companies. So be it names like Larsen, where we have seen in the current fiscal almost 40% growth in the order inflows is expected. Next year, we are actually expecting a decline to flattish inflows for Larsen. Same for other companies, at least for the first 6 months, we're expecting flattish to marginal softness in order flows. On the private sector, also large ticket size greenfield projects, be it steel, cement, etc., could see some moderation in finalization during this election period. But nonetheless, towards the second half, we expect these to catch up. So I think overall, private sector has been holding up. The large ticket size orders from core sectors will see finalization in the second half of the current calendar year. Otherwise, I would broadly say the capex cycle should hold, and if government is able to execute well on certain reform activities in the power sector and key rolling stock ordering on the railway side, one will see a meaningful pickup in order flows in the next 2 years for the sector overall.
For Larsen, Renu, there was some news flow that the Saudis are lowering what they're going to spend on this new city, which they were building. I mean, some dramatic cuts. Of course, other development work, etc., in that part of the world is going on, but that was a single large. I think it was going to spend some $500 billion or something. At least that was a number which was put out. Is the pickup in Middle East as a large contributor a big reason for the share price performance we've seen recently, and is this a dampener?
For Larsen?
For Larsen, L&T.
Yes, as in for L&T, Saudi and hydrocarbon specifically have been one of the biggest driver for order flow growth in fiscal 24. And some of the news flows and announcements from if you look at Saudi Aramco, and even as a region to slightly consolidate the spending has been a bit of sentiment dampener. But practically from an order inflow perspective, because some of these projects and city development are long-drawn projects spread across 4 to 5 years. In terms of on-ground ordering activity, I don't think so there is much derailment. But yeah, the pace of order finalization and especially the current geopolitical tensions could add incremental risk elements to projects in the region there.
All right, Renu, we'll let you go on that note. Thanks a lot for joining in. Appreciate your time here. Let's slip into a quick break. On the other side of the break, we have the commodity discussion. Manisha Gupta joins in. She'll tell us all things commodities. Stay tuned.
Okay, we'll come back 10 o'clock and the market's doing, is come up nicely, right? Look at that, 10 points higher, 12 points higher on the Nifty right now. Maybe just put up the biggest damage there, which was Kotak Mahindra Bank, and see if there is anything there to kind of a recovery in Kotak Bank or elsewhere. Nothing at all, 10% lower, but maybe what was up is up a little bit more. So names like Axis, etc., perhaps also should come up on your screen. If anything, actually Kotak's now limit down, and it'll stay there for a while and then it'll open up. Mitesh is with us with what to do now as far as the index is concerned. Mitesh, so the morning dip, it's now in the flat terrain. Is there a trade in the index? You were saying in the morning you're avoiding index trades, but what would you want viewers to do?
I think we've not been trading the index for last few days, but today, as I said, I think around 22,300 intraday averages, and you might get a bounce back. But the bigger trade will happen once you get a closing about 22,500. If somebody's bought today, I think these are the levels to take profits, 22,400, 30, 50 zone, and then wait for the index to get past 22,500. On the stock side, I have a sell on SBI Life. I think that's the stock breaking down. So keep a stop at 1460 to for target below 1400 here, and a buy on Axis Bank, which obviously with the numbers I think has opened with a gap up and given a good breakout. So Axis Bank is a buy with a stop at 1085 for targets of 1150.
All right. Well, since you're talking about Axis Bank, right, let me go across to Abhishek. He's joining in. Abhishek, what's the latest on Axis Bank?
Well, it was a beautiful quarter with respect to Q4 FY24 for Axis Bank, and records have galloped over there. Take a look at the gross NPA ratio. It's the lowest in last 34 quarters. Take a look at the net NPA ratio. It's perhaps the lowest that you are seeing in last 35 quarters. Now, net interest margin has actually expanded. There was a fear, or analyst estimated that, net interest margin will decline in this quarter by 9 basis point was the estimate by Morgan Stanley. However, the net interest margin has expanded 5 basis points sequentially thanks to the domestic net interest margin, which actually grew by 8 basis points on a sequential basis. ROA has touched 2% for the first time that I am seeing for Axis Bank in last 9 years. ROE has crossed the 20% level for the first time that I am seeing in last 9 years. So annualized slippage ratio is at 1.44%, perhaps the lowest in last 14 quarters. Analysts were pegging that slippages will rise in the coming quarter, that is Q4 FY24, anywhere between 3,750 to 4,300 crore. However, slippages have declined. They have come down to 3,400 odd crores versus 3,715 crore in the previous quarter. CASA ratio has improved for the first time in last 3 quarters or 4 quarters. And PNL, both the ANA and PAT is a beat on our poll. PAT is also aided by other income. Back to you.
Thanks a lot for that, Abhishek. But the stock of the morning has to be Bharat Forge. And Nimesh joined us earlier to give us the top brokerage report. Nimesh, the stock is firing away. Tell us more.
Well, it's the biggest F&O gainer on the back of a big upgrade coming in from BofA Securities. So today they've upgraded the stock to buy from underperform, and they've raised the target price on Bharat Forge to 1450 versus 1000 earlier. Now, BofA expects US truck down cycle to be very short, shallow and priced in. In fact, they are not seeing any softness in production yet, and the freight indicators have also bottomed out. In fact, there will be new kickers of growth for Bharat Forge in terms of defense revenue going up, in terms of the PV export on a high, as well as the industrial casting business improving from here on. In fact, the stock has actually underperformed Y2D both in terms of local peers as well as global peers, and which is why the risk reward is stands out according to the BofA note. And they are forecasting an EBITDA growth of 20% and an EPS growth of 40% plus between FY24 and FY26 estimates. So a double upgrade on Bharat Forge by BofA Securities to a buy now with a target price of 1450.
Okay, thanks a lot for that. Well, let's go back to Abhishek. He's talking about MAS Financial. The stock is also buzzing in trade. Abhishek, over to you.
Well, consistency performance that you are seeing from a lender is MAS Financial since the time they have listed. So disbursements are up 15% YOY and 5.2% sequentially in Q4 FY24. AUM growth is robust at 25.1% YOY and about 4.7% sequentially. So the NII growth is 39% YOY and about 10.9% sequentially. It's perhaps one of the few lenders who has seen net interest margin expand both YOY and quarter-on-quarter. Calculation shows that the net interest margin might have improved to 5.84% when compared to 5.26% in the same quarter last year and about 5.5% in the previous quarter. So PAT is grown at 22.7% YOY and about 9.1% sequentially. Asset quality slight hiccup over there. Gross NPA ratio has inched up by 2 basis points on a sequential basis. Back to you.
Okay, all right, Abhishek, thanks a lot for that. By the way, on the Nifty, from the lows of the day, we've recovered a good 100 points. You're making this point earlier today. Options data suggested 22,320 mark. That was going to be important on the downside. When you have shorts in the system, well, it gives you some cushion. Explains why we have seen such a big increase from the low point of the day. Well, let's keep equities aside. Let's focus on the commodity space. Manisha Gupta joins us to fill us in with what's going on there. Manisha.
Thank you for that, Nigel. I'm looking at the crude oil prices because we've seen very volatile moves come into this one. We are holding back above $88 a barrel. Remember, last week was a 3% decline. But this week, we've more or less tried to play that range between 87 to 91 on the higher side. Well, the strength comes in on the back of decline in US dollar index, which is still holding below 106. And that has led to buying in many of these dollar-denominated commodities. So when you look at the crude oil prices for the month of April, we have seen 3% of gains onto this one. It clearly is off the a high of $91.50 a barrel, which was not just the high in April, but the high for this year as well. Since then, this has continued to base as a resistance in case of the crude oil prices there. We also are looking at a very big gap when you look at the US crude and the Brent crude prices. So 83 and 88 tells you that there's a $5 of a gap between both the crude prices here as well. Markets also have reacted to the EIA data, which is showing 6.4 million barrels of a draw in the US inventories. Well, the street was anticipating 1.6 million barrels of a build-up. So this has been a surprise and is the reason that you are looking at that 0.5% of a gain for the crude oil prices there. Well, it also is about the US GDP numbers and the PCE index data that comes in from US in today and tomorrow, and that would give you further direction. Markets also have seen some buying ahead of these numbers. Well, this will tell you on inflation and the rate cut cues going forward. But most of the tangible commodities actually have come into buying ahead of this important data. And then there is a lot of contradicting fundamentals also continuing in case of crude oil prices is the reason that you have seen $91 hold as a resistance. The one is that oil tankers, which have been idling at Red Sea, have made now progress in deliveries, which is reaching its destination. So that concern about delayed and disruption in supplies also seems to be getting taken care of. The other thing is about lower expectation when you look at military escalation in the Middle East. That has taken some premium off the prices as well. Analysts would tell you that nearly $5 to $8 of a geopolitical premium buildup that we are seeing in crude is something that the crude prices will more or less continue to maintain. But if we see more de-escalation, then the crude prices can decline to 85 and levels of below as well. Well, the US is looking to reinstate sanctions on Venezuela, which has already happened, and Iran companies, oil companies as well, could come under that radar. That would be an added positive sense in case of the crude oil prices there. Interesting report from ANZ which says that the global oil demand for the month of April stands at 101 million barrels per day, which is still on the higher side, and we have seen demand continue on the stronger side from US. China physical markets continue to buy as well, and Europe, while has enough gas, but the crude imports there have been on the stronger side. So a couple of supportive factors coming in from there.
Okay, thanks a lot for that. Let's take a quick break. On the other side, we'll be joined by Puneet Chhatwal, the MD and CEO at Indian Hotels, to discuss the company's Q4 performance. Stay tuned.
Okay, strong recovery from the day's lowest level, about 130 odd points worth on the Nifty. And there's a sharp spike, which of course is now emerging. at this point in time. On the Nifty, if you want to see what is really leading this spike, Kotak, of course, is not helping the cause. But even without that, right, it's Axis Bank, the number one contributor to the index, 30 points. Number two is ICICI Bank. So in a way, the market making the assumption. Of course, Axis reported numbers, but even otherwise with Kotak, in important segments, credit cards for Kotak is not a big segment at all. But markets making the assumption that maybe the other sort of peers there would gain. ICICI is at the number two position in terms of helping the Nifty gain, and number three is Reliance Industries, adding about 15 index points. So all of it combined, 50 on the Nifty right now. Let's put the focus on Indian hotels now. It reported its best fourth quarter performance ever. Margins have expanded and operating leverage. New businesses have also reported growth of about 35% or so. What's the outlook looking like for FY25? That's the question, isn't it? We have Puneet Chhatwal, Managing Director and CEO at Indian Hotels, joining us now. Puneet, good morning. Great to have you with us here on the program. Prashant this side. Travel and leisure and hospitality continues to boom. And I think that's what the FY24 numbers show us. Revenues for the full year have grown for you 17%. EBITDA is up 20%, margins of 32%, and net income up about 25% or so. Give us, to start off this conversation, let's get the numbers out of the way, and then we'll talk about, the finer aspects of the business, the nuance, etc. What's the guidance for FY25? Will you maintain this kind of run rate?
Morning, Prashant. What we have given as guidance is opening 25 properties at a minimum in this coming 12 months. And we had guided 20. We opened 20 last year. If we add the Tree of Life to it, then it goes to 34. So I think on a growth trajectory, we have been delivering on that promise, and the capital light growth is helping us drive the margins, and the capital heavy with good smart renovations is helping us drive the operating leverage, and our guidance remains the same. Why change a winning combination? All we have done is we have increased the capex spend because we are going to spend a lot of money on digital initiatives, on our new ERP, on our new data lakes, on our new websites, which we start launching, the very first one in the next 10 days, and then for all our brands. So I think with smart renovations, effective asset management, digital initiatives, growth on all fronts in terms of number of hotels, number of homestays. We signed last year 105 new AMA branded homestays. We are now more than 100 in operations. And also cumin, bringing cumin to every ginger property has proven to be a good formula for us. So all in all, we are very pleased with the performance, and we do believe that we're going to sustain it for many, many years to come.
So, again, got that, and that's well put, Puneet. Margins of 32% are maintainable in FY25?
Yes, for sure. We are not into cost cutting, as I just now said. We are actually spending. We are supporting our new businesses. And as you mentioned at the beginning, we are looking at 30% plus CAGR on our new businesses, which requires more advertising, which requires more websites, which requires more people. So we have been doing that for the last 6 to 9 months under the vertical of new business, and we are very, very optimistic that this journey will continue because demand will continue to outpace supply. And for our portfolio, there are 2-3 important elements which have not yet kicked in. First, the foreign tourist arrivals is at an all-time low compared to the pre-COVID. Of course, last year we had the benefit of G20 in terms of statistics, but it still did not achieve the number of pre-COVID. So I think there is some movement expected to happen there, which will help our palaces and our iconic asset portfolio. Number 2 is the US has been lagging behind also on the pre-COVID. And we have taken some steps which will help us going forward. And finally, I think the journey that we commenced on our not like-for-like growth with more than 90 hotels in pipeline, we expect to open more than 100 hotels over the next 3 to 4 years. This will really help because of the balance that we have created in capital-heavy and capital-light businesses.
Puneet, hi. Always great speaking to you and understanding how the hotel industry is shaping up. But I have a couple of questions, right? How long do you think this runway of growth is going to last? And at what stage of the upcycle are we in the hotel industry? Has it reached a mature stage already?
Sonia, can I answer a bit on a lighter note?
Always.
2 years ago, and I said the rates will go up. You asked me last year, I said, no, the best of the rates is yet to come. And my answer does not change. With the kind of service we are providing and post-COVID, the divide in the West and the East has, grown significantly, that your ability to charge and people's willingness to pay has increased, and also the appreciation of dollar. Pre-COVID, we were at 65, 66 rupees. Now it is at almost 83 point whatever. If you convert that back for our most iconic part of our brandscape, that is the Taj, we are still like close to only $200 average rate. So I think this journey will continue. And as India grows from 5th largest economy to 4th, and then finally to 3rd, the per capita income will also grow. And if the per capita income grows, the discretionary spend becomes a normal consumer spend. And that has been my belief, and that's what we've communicated.
So you also made a point, Puneet, that foreign tourism is still relatively low and it's expected to pick up going forward. The other 3 pockets I wanted to ask you about, one is spiritual tourism. You also have the resurgence that you're seeing of medical tourism, right? I mean, that as well is picking up in a big way. And then you have luxury or premium tourism. Where do you see the maximum potential now over the next 12 to 18 months?
See, spiritual tourism is very important and has always been. Actually, we started talking a lot about it, maybe in connection with Ayodhya. But we have been in Banaras and we are expanding our hotel, doubling the size of the Taj Ganges because the demand level is so high. And, many other we have added a 2nd hotel in Tirupati. We have 2 hotels in Katra. So we are in 50 plus spiritual destinations with 60 plus hotels there. The beauty of spiritual tourism is on the room demand side, it helps you in resilience. So for good or for sad or for happy reasons, people do go for, spiritual weekends or weeks, if I may say so. The second important resilient factor that is a part and parcel of the Indian subcontinent culture is the weddings. This is a very big business in India, and we are very well positioned to take advantage of the wedding segment, and that keeps growing. But more importantly, I think a lot of people tend to forget that the facilities that have been built, like the Bharat Mandapam, the Yashobhumi, both in Delhi, the Jio in Mumbai, the Kolkata Convention Center, and many others that are coming all across India, the new 4-lane highways, the airports that are being added, doubling of the number of airports, the number of new aircrafts coming into India. This is going to lead to a very different kind of a positioning of the sector in the next 2, 3 to 5 years. And I just think at the moment, we have not even captured 5% to 10% of the possible demand because these centers are either in an opening phase or just open because of G20. But as we all, Sonia, are in Mumbai, if a big event is happening at Jio, within the 5-kilometer radius, there are no rooms available. So these kind of structural changes and shifts are going to really boost the hospitality sector. And we being the largest ecosystem in this sector should get our fair share of that benefit.
All right. Hi, Puneet. You're sounding very, very confident. Now, Vision 2025 was achieved a year ahead. So what's the vision for the next 5 years, if you could run us through that? And also fill us in with what's the difference between margins between domestic as well as international business, and what's the upside there?
Nigel, I think on the guidance, we will very soon announce our capital market day and give it at the same time to all. But mainly the growth journey will continue. I think if 5 years ago we had said we'll be a portfolio of 300 plus hotels, and at that time we were 120, very few believed us. When we said aspiration 2025, that we'll do 25% margin, very few believed us. Now we have the other side. When we say 33, people say, why can't you do 36? So I think management's job is to navigate through all these situations. And I think 30+% margin on a healthy top line is good. And I would also like to state here today that in our last announced results, our standalone revenue is higher than what was pre-COVID for the consolidated portfolio. And it's not coming just from like-for-like portfolio. It's also coming from not like-for-like portfolio. So the guidance remains effective asset management, use capital heavy as an opportunity to drive higher returns, because we have such beautiful iconic assets which are sitting over so much of space, including FSI, that we can use intelligently, and we've been doing that. Drive margin expansion through capital light businesses as well as new businesses and scale them up so that the volatility in the portfolio declines to the best possible or the optimal possible level.
You know, Puneet, one of the triggers that you mentioned, which could play out, is foreign tourist arrivals, right? Especially US arrivals from US, etc. What will cause that to happen? I mean, why is that still low, according to you, briefly?
You know, there is a shift, just like there was a shift of, customer behavior during COVID and post-COVID and people driving with families on a holiday. There has been a temporary shift because of the pandemic. People have stayed more at home, and it was also complicated getting visas, etc. It took a longer time. And then we all know that in certain countries, we had also put embargo for people to come in. So I think all in all, everything also goes back to some form of a new normal. And I think in the new normal, the foreign tourist arrivals in India will grow exponentially in the years to come. And why should it not grow? We have 7,500 kilometers of sea mass. We have 500 plus beaches in India. We have the mountains, we have the temples, we have all possible religions represented in India. We have the Buddhist circuit. So as India grows, as India develops, all these new circuits are already developing and will develop. The life will not be just limited to Golden Triangle, Delhi, Agra, Jaipur, and extended to Udaipur. So it could be, Delhi, Banaras, Ayodhya, Sarnath, the Buddhist circuit, the Northeast, which is coming up very strongly in terms of business. So I think a lot of new things are happening in India, which should boost both domestic tourism as well as international, but more importantly, business. India is becoming a preferred business partner for a lot of important and large economies of the world. And I think that will bring in new business into metros, and the supply will remain constrained, which will give us as a sector the ability to charge and also have good occupancies.
Absolutely well put and well-rounded there, Puneet. Thank you very much for joining us. It's a pleasure having you with us here on CNBC-TV18, and good luck to you, to your team, which has been executing fantastically well over the last many years now. Thank you. Well, I think we're out of time completely here on the show. Markets steadied a little bit. I mean, it was looking like a bit spiky, but now about 40 points higher. 22,440 is where we are at. We'll wrap up this edition of Bazaar from all of us here. Goodbye. Thank you for watching. Chartbusters will pick up on the action in just a bit.
Kotak Mahindra Bank falls 10% after the RBI bars the bank from onboarding new customers through its digital platforms and restricts the bank from issuing new credit cards. Brokerages also see the action as a significant setback. Jefferies cuts the target from 2050 rupees per share to 1970 rupees per share earlier.
Axis Bank climbs nearly 4% on the back of a stellar showing in the quarter. Profit beats estimates, while NIMs improve sequentially, contrary to expectations of a decline. Brokerages, they are bullish on the stock.
More earnings impact, and on the downside, we have LTIMindtree dipping nearly 2% after fourth quarter revenue and margins came in below expectations. Dalmia Bharat too now down 5% as the results were much below expectations.
Indian Hotels sees some profit taking after posting its best ever fourth quarter numbers. The management tells CNBC-TV18 that there is some still further upside to room rates. They are all set to open 25 new properties in FY25.
Mass Financial surges over 6% after delivering a good set of fourth quarter numbers. Net interest income grows 39% year on year, while disbursements rise 15%.
Hello and welcome to Chartbusters. I'm National D'Souza. Joining me as always is Mangalam Malu. The screen is green, but we started off well in the red. The Nifty seems to have taken support at lower levels at around 22,320. And from there, we've seen a big bounce. Well, on the banking pack, you have two opposites of the spectrum. Kotak Mahindra Bank is the biggest loser, while the PSU banks, they're moving with momentum. That's the index that's gaining the most. Mangalam, interesting looking screen. The big move really will come, I think, towards the end of trade. But for the time being, you have to say, buy on dips continues. You have shots in the system which will support as well. The bulls will be feeling quite good.
Bulls would be feeling quite good, because Kotak Mahindra Bank, one would have thought that had the potential to take the Nifty Bank lower. So instead of the headline being the Nifty Bank is lower because of Kotak Mahindra, the headline now is Nifty Bank and the markets in general are higher despite Kotak Mahindra Bank. So down 10% for Kotak Mahindra Bank, not doing too bad for the market on account of that. So the Nifty back at around that 22,450 mark. The question is where it goes from here after the first support that it took around the 20-day moving average itself. So good time to get in Sachidanand Uttekar of Trade Bulls for a quick technical check on the market. Sachi, we've seen the first leg of support play out and the markets recovered from the lows. The question is now what? Around that 22,450 mark, does it make sense to enter a trade?
Good morning, Mangalam. Good morning, Nigel. I think the market should consolidate for the day. In fact, if you look at the data, clearly, 22,305 is where its 20-day exponential moving average support was placed. And at the beginning itself, it has respected this particular support. Now, if you look at the expiry zone as well, it is placed somewhere close to around 22,400. So probably we may see, some resistance near this particular level at 22,450. But on the lower side, we don't see the market, slipping below that 22,300 mark. So probably we may see a full day of consolidation here. We may not see any further fireworks when it comes to Nifty. And even in Bank Nifty, if you look at the data, 48,300 looks like a resistance, but on the lower side, 48,000 should act as a very good support.
Okay, all right. What about individual stocks? Sachi, what are you looking at?
Nigel, it's better to keep a long-short combination. On the long side, we have Chambal Fertilizer, which has delivered a decent performance throughout the week. If you look at the weekly structure, of almost 3 months, it was facing a good strong hurdle around that 400 mark. Now that particular resistance has been breached. It's a clear-cut breakout from a rounding bottom formation on its weekly scale. It is exhibiting a potential price target on a positional basis placed at around 460. From a trading momentum perspective, I think the stock has already, displayed a good strong move. This particular momentum may continue towards 415 on a short-term basis. The positional target is placed at 460. So we are recommending building long positions here, keeping a stop loss somewhere close to around 395 when it comes to Chambal. On the short side, Apollo Hospital, the trend has been fairly bearish. We have already seen a breakdown from a rising channel kind of formation on its daily scale. And post that, we saw a good pullback rally. And this particular pullback has again garnered some fresh short positions here. So we are expecting that this particular momentum may continue in the coming week as well. We may see this particular stock slipping towards 6150 levels. So that's why we are recommending building short positions here in the May futures. Keep a stop loss somewhere close to around 62.85 and a trading target is placed somewhere close to around 6150.
Take that point, Sachi. Thank you so much for joining in. Wish you a happy expiry. Thereafter, we will speak to you next week as well. But the stock of the day definitely has to be Kotak Mahindra Bank on the downside after the Reserve Bank has barred it from onboarding new customers through online and mobile banking channels, issuing fresh credit cards as well. The action comes after the central bank cited concerns over the lenders' compliance and risk management practices. We have Ritu Singh joining in now with the details. Ritu, stock down 10%. What more does it mean?
Well, it is a significant setback, which is why you're seeing that stock reaction today. Kotak Mahindra Bank being asked to stop onboarding new customers through online and mobile banking channels and also stop issuing fresh credit cards, both of which have been engines of growth. Now, in a strongly worded press release, RBI said the action was necessitated based on some significant concerns arising from the IT examination of the bank in the last 2 years and the continued failure on the part of the bank to address these concerns. The compliances, RBI said, submitted by the bank were found to be inadequate or incorrect, and despite high-level engagements with the bank on these concerns in the last 2 years, the outcomes, and I quote RBI, have been far from satisfactory. The restrictions, however, will be reviewed after an external audit and remediation of these deficiencies to the satisfaction of RBI. Now, if you know, this is very reminiscent of what happened in the case of HDFC Bank in 2020, where it took nearly 15 months for all of the restrictions to be completely lifted. Coincidentally, the action on both HDFC Bank and Kotak came after their long-time CEOs had left and new CEOs were barely a few months into the job. Now, brokerages see this as a setback for the bank. They see an impact on profitability if the embargo stays on for a long period. Macquarie notes that a good proportion of Kotak's assets and liability products are being sourced digitally. For instance, 72% of savings accounts being opened by Kotak's 811, and so the business growth could be affected. It highlights Kotak has only opened 350 branches in the last 4 years, and that could be an issue going forward. Nomura says it is going to watch out for any step up in technology spending by the bank and adds that the impact on business and profitability could be limited, but there will be a reputational impact. Citi says RBI's action will adversely impact NIM and fee income. CLSA believes the profit impact will likely be modest unless the ban stays on for too long. And Jeffrey says that if the resolution takes more than 6 months, there will be an adverse effect we'll see on revenues and costs. The target price in the stocks, they range from about 1860 from Macquarie to 2100 rupees per share from CLSA.
Okay, all right. Thanks a lot for that, Ritu, for joining in, giving us that quick update. Well, time to shift focus to our special segment where we get you a few ideas for profit from Money Control Pro. Jitendra Gupta joins us to fill us in with the stock that is tracking closely. Jitendra?
Given the current environment, I think utilities like Power Grid provides good opportunity. India's largest power transmission company is riding on a wave of strong capex. The company increased capital expenditure due to surge in power generation and renewable energy projects. Its business is improving. During December quarter, it reported impressive 2.6% year-on-year growth in revenue. Notably, their core transmission business saw a healthy 3% increase. This growth was fueled by strategic investments and rising electricity demand. During the quarter, EBITDA margins increased slightly, leading to overall 11% jump in net profit compared to last year. Looking ahead, Power Grid plans to undertake capex of close to rupees 1.75 lakh crore over the next 8 years. This translates to an annual capex of almost 20,000 crore. It already secured projects worth rupees 26,000 crore in the first 9 months. Notably, 70% of their ongoing projects, which are valued at about 77,000 crore, are dedicated to renewable energy projects. In terms of valuation, Power Grid offers reasonable safety due to earnings visibility. It is trading at 2 times to the 2026 estimated book value and offering a dividend yield of close to 4%, which is quite good to my mind.
We take that point. With that, let's slip into a short break and come back after the short break, talk more about the markets and a lot of individual stocks. Stay tuned for that.